Welcome to America's Commercial Real Estate Show, your source for intel, forecasts, and success strategies. Hello, I'm Michael Bull. Thanks for being with us. Maybe you're on iTunes, YouTube, show website, or wherever you are listening. We appreciate you joining us. Our show topic today is Hotel Industry 2018. This segment is brought to you by Build Out. If you're a commercial brokerage firm, check out buildout.com. You'll be glad you did. So the hotel industry 2018, what's going to happen? Well, a lot of things have been happening. The hotel industry for the last several years has done very well, but what's in store? What's coming up? We've been in this great economy for a long time. How long is the cycle going to last? And so we'll talk about it today. Performance, we'll talk about cap rates, we'll talk about pricing, and we'll have some principals, some developers to kind of get an inside view from their desk of the industry. Please, let's first welcome Warren Marr. Warren is U.S. Hospitality and Leisure Managing Director with PwC, and he's joining us on the phone. Warren, thanks for being with us.
Thanks for having me, Michael.
Well, Warren, what do you see for sales values? What are the trends for values and cap rates for the hotel industry? You know, what did you see in 2017?
Well, we've seen so far this year that the cap rates are going up slightly in the full service segment. And full service hotels are hotels that have restaurants, meeting space, cocktail lounges, that type of thing. And they're going up more meaningfully in the limited service, lower price chain scale segments, up almost 50 basis points from a year ago. But again, not materially changing from where they have been before, because we continue to have a low interest rate environment. We have supply that, while it is increasing, new hotels are being built. They're not being built at nearly the rate that they were built in other economic recoveries.
Well, it's interesting. So values declining slightly, well, at least based on the cap rates. But what do you expect moving forward, Warren, into 2018?
Well, that's the $20 million question. And a lot of that has to do with what happens with the economy going forward. This year, we've had a very strong economy from a stock market perspective. The stock market's done very well. But growth in GDP at the beginning of the year wasn't all that aggressive. It started to increase in the latter part of this year, and with the pending tax cuts they're running through the Senate and the House right now, we could see a more meaningful growth into 2018, which would drive profits and therefore drive values for the hotel sector. Okay.
So what about performance? So if cap rates have increased a little bit in 2018, how has the hotel industry been performing? How about RevPAR and things?
So RevPAR this year has been up and is expected to. And we came out with our latest forecast in November, and we were forecasting that 2017 RevPAR would be up about 2.6%, which was an increase from what we had in our forecast a quarter before. As I sit here today, just before we break for the holidays, I don't foresee a situation where 2017 comes in below where our number is. I actually think, given the results of the last month and a half in the U.S. overall, that RevPAR growth could be north of that 2.6% before it's all said and done in 2017. A lot of that has to do with the anomalies of, surprisingly, the hurricanes. You sit there and you think, oh gosh, a hurricane happens in a market, it's going to devastate the hotel industry. Well, depending upon what happens, it can actually be a boost. In markets like Houston, we're seeing RevPAR up over 50% for the year. A lot of that has to do with the displacement of families in the market that are being put into hotels by FEMA and other programs, as well as the construction crews that are now coming down to work on the infrastructure in that metropolitan area that need a place to stay. So we've actually seen significant growth in markets like Houston, certain pockets of Florida that weren't anticipated prior to the hurricane season.
Yeah, that's interesting, and almost a windfall, if you will, for some of those hotel operators. I know some of our clients that own hotels were reporting that their hotels were absolutely full and around those areas. So that is interesting, especially when you think about what you just mentioned about the construction folks coming in, in those markets. That's very interesting. What about new supply, Warren? What have you seen there, and how's that impacting the market?
So new supply in 2017 is expected to be up, or supply growth is expected to be up 1.8%. So an increase in supply of 1.8%. The long-term average for the U.S. lodging industry is about 2%. So still slightly below that number. And even next year, we're having it inch up a little bit to 1.9%, but still at or just slightly below the long-term average. So when you think about an economic recovery, and these, by the way, those 2017 and 18 are going to be the biggest growth percentage increases we've seen in this recovery. So when you think about a recovery period, you would expect to see supply growth above the average. Mm-hmm. We're not seeing that. And a lot of that has to do with disciplines that were put in place after the events of late fall 2008, where the banking infrastructure now is set up to really vet these projects much more conservatively than they were in the past. And so we don't have the supply growth that we have seen. Now, there are certain pockets of the country where you'll see supply that's increased. Houston is an example again. That was one over the last couple of years where we had significant supply growth. And that impacted negatively the market. On the flip side, you've got markets like Nashville that have had significant supply increases yet continue to beat performance expectations and have very strong RevPAR growth year over year. So again, I don't think supply is going to be the Achilles heel in this particular recovery. It could be in certain pockets of the country, but from a U.S. overall perspective, supply is not going to be what disrupts this growth platform.
We're speaking with Warren Marr with PwC about the hotel industry. So Warren, if we have kind of healthy levels of new supply, you're expecting kind of continued growth in RevPAR and performance of these properties. Is it kind of, are we good to go in 2018 and 2019? Is your outlook that, hey, we're okay, we're not overbuilding, performance should be fine? Is that sort of the outlook?
Well, I think there's two parts of that question. Mm-hmm. We're not overbuilding was one of the parts of the question. The other one was we should be fine. And I don't know that those two things are necessarily interlocked.
Yeah.
There's a lot that could happen in 2018. There's many more unknowns that could happen in 2019, and we just don't even forecast out on a national basis for 2019. For 18, we're expecting RevPAR to be similar to where it was in 2017. Now, I say that caveating that when we did our last forecast, the situation with the tax codes was still in flux. It seems a little bit more clear right now as to what may happen for 2018. So we could see 2018 actually be a little bit stronger than what was anticipated earlier. What we're really seeing across the country is that demand growth, and this is the interesting piece, is that occupancy, where we are in occupancy right now, you would expect to see much stronger room rate growth than we're seeing. Every quarter, when we look at things, we say, okay, finally we're at a point now where rate's really going to start to turn up because occupancy can't go any further. And then occupancy continues to defy and go up further. We have occupancy levels right now that we haven't seen since the very early 1980s. And so it's a really interesting situation here, yet we're not able to push rate as much as would be expected because we also are in a situation where we have complete transparency in rates that we didn't have in other cycles. And by that, I mean, people can go on online travel agency sites like Hotels.com, Expedia, Travelocity, and Bookings.com, and see, the entire market, what the rates are being charged on any given night for all the different products. That affects the ability to drive rate. It also gives you an opportunity to push more leisure business into pockets of a given week that normally wouldn't be strong, like a Sunday night or a Thursday night.
Right, because you can adjust things pretty quickly, I guess. And yeah, I think it's a good point, Warren, with the sharing economy, the technology, and we're all able to hopefully get better deals on things, right? The knowledge is out there. So you're seeing increased occupancy in the hotels, but not necessarily the income growth. And you mentioned the Tax Act. So as we speak today, this morning, the Senate passed the Tax Cuts and Jobs Act. And, Senator Ryan, or the Speaker of the House, Ryan, is suggesting that a median income family of four is going to see an extra $2,000 in their pocketbooks in 2018. And if leisure is a big growth opportunity for the hotel industry, hey, I know if I had an extra $2,000, I might want to go on a trip. might that be really beneficial to this industry?
Yeah, I think, look, the devil's in the details, but if indeed that happens and the average middle class American does see that kind of an increase in their wallet, I think you can expect to see an increase in leisure travel spend here in the U.S. And it's important and very interesting to note that in this recovery, and particularly this year, what is really driving that increase, that incremental increase in occupancy, has been that leisure traveler. It hasn't been the commercial business traveler. That doesn't mean that they're not traveling. They are traveling, but the significant growth that we're seeing in demand is not, or continued growth in demand is not coming from that business traveler. It's coming from the leisure traveler. It's also not coming from that group traveler, the conventions and meetings business. In fact, that's down this year. So when you look at if you look at the hotel industry, many people compartmentalize it into three main segments: the individual business traveler, the convention or meeting travel person, and then the leisure traveler. The one that is not on an expense account is the leisure traveler. They're the most price sensitive. And so with them driving a disproportionate amount of the growth that we're seeing in demand, that has an impact as well on pricing and the ability to drive rate. I'll give you an example. The U.S. lodging industry this year is expected to finish at about 65% occupancy. Well, actually a little bit higher, almost 65.8% occupancy. Manhattan is running an occupancy for the year at about 90%. I went online just before we started this interview, and I can book a hotel room in Midtown Manhattan tonight for under $100.
Wow!
At a hotel I'd actually stay at. So that tells you they're driving that demand, and they want to run, and they'll run that occupancy, continue to run that occupancy. But here we are the week before Christmas, and by the way, Manhattan is the one market where the month of December is one of the strongest months of the year because of the leisure traveler coming to Manhattan for the holiday, to see shows, to do shopping, to do whatever. The international leisure traveler into New York in December is phenomenal. But I can book a hotel room tonight for under $100 in Midtown.
Yeah, it is interesting, and a place you would actually stay. Warren, great information. Thanks for joining us today.
Happy to be there. Thanks for having me.
And stay with us. We're going to have a principal, a broker, and a developer in the hotel industry next. Stay with us. I'm Michael Bull. This is America's Commercial Real Estate Show.